Good afternoon, guys. Today is Tuesday, February the 22nd. So I was out of the office yesterday, and many of you are heading to Canmore for a conference tomorrow, Wednesday. And Friday is going to be an open class as well because I'll be out of the office. So I did not want to leave everything for a full week prior to getting back together because we're a little bit late in the semester to lose a week. And so while this was going to be a work week for the most part anyways, I did have some theory that I wanted to go over. So what I thought I would do is put together a video. This video should be 15 minutes or less. That's going to go over some of the high-level aspects of Chapter 9. You will notice that I have opened up the Chapter 9 assignment Dropbox, and the assignment will be due next Friday, December the 2nd, and the quiz will also be due next Friday, December the 2nd. So this information will be sufficient to get you guys started. Again, I'm going to cover the main topics that I would have covered in class, and then I'll dedicate a little bit of time on Monday. Actually, Monday you guys are going to be in a safety event, which you guys should hopefully have been aware of. If not, I will make sure that you guys are aware of that prior to Monday. And so that means on Wednesday, if there's anything that is outstanding, I will happily go over any of the material. So the material itself is pretty straightforward, I think. There's a little bit of math involved in this, but it's nothing too severe. And I've got some good templates up on Moodle that will hopefully guide you guys through the theory as well as guide you guys through the assignment. So you can see I've got everything open up here on Moodle. The video that I'm recording will be uploaded here probably by about 3 o'clock-ish on Tuesday. And so with that, let's click on the worksheet and take a look at the material. So Chapter 9 looks at financial structure. Now, this is not something that small to medium-sized businesses will look at. Rather, it's something that larger organizations will look at. Have I used this information? Yes, both with larger organizations that I've been part of and a couple of times with some of the smaller businesses that I've been involved in. And I'll talk about those when we get to those particular questions. So again, I'll try and keep this to about 15 minutes. So I'm going to go through not quickly, but anything that I think you guys can read, there's no sense me just lecturing to. All right, so again, if there's any questions, please email me or write them down, and I will happily go over any material that we have to go over here next week. You probably can't see this too much, but I've got 2 tabs down below, and these tabs are for self-test 9.1, 9.2, and 9.3 and 9.4. So looking at capital structure, essentially what we're looking at is all the debt, all the loans that we're taking out. You'll know at this point already that you're never going to get all your loans at the same interest rate, and nor should you. There's a variety of different sources of financing, and each of these sources of financing are going to have different returns and different costs associated to them. And so what we want to do is take a look at all our different sources of financing, whether it be from our customers, from our suppliers, through accounts payable, whether it's through loans, whether it's through our own retained earnings, or whether it's from issuing capital or shares or bonds or anything along those lines. They're all going to have different returns. And so what we want to do is figure out what the overall cost to our organization is to take out and borrow money from all these different sources, including even our own retained earnings, because we need to make a return on those as well. All right, so that's the financial structure that we are going to look at. So essentially, I'm just going to skip over the problem solving for 9.1 and just jump down into the self-test for 9.1. So we have a variety of different sources of funding. We have share capital, where the organization issued shares to raise money. We have our trades payables, accounts payables. We have our retained earnings. So that's where we're using our own savings, our own money to further our business. All right, if we want a return for that, because we can actually invest that money in the stock market, so we'll want to earn some money on our money, and so that's a return that we are going to demand from it. Long-term borrowings, those are the bank loans that we're getting for mortgages, equipment, etc., etc. And term loans is the more shorter-term loans that we can take. So it might be a line of credit, or again, you might be financing a short-term piece of equipment, whatever the case may be. So if we take a look, we have these items here for 100,000, 20, 58, 50, and 40. And so what we're looking at are two items. We have our financial structure and we have our capital structure. So financial structure is all the debt, both short-term and long-term, right? So short-term and long-term. Capital structure or capital costs are just those long-term costs. All right, so if we take a look here, we have all the different items, right? The different amounts that we've borrowed. And what we want to do is figure out what portion of our overall debt, our overall financing, overall cost structure, each one represents. So here, if I add everything up, so 100 plus 58 plus 50 plus 40 gives us 248,000. 100,000 divided by 248, and I do have the formulas in here as well, right? So if you take a look, you can see the formulas. You'll see that our share capital represents 40% of our overall financing. Our retained earnings represents 23% of our overall earnings, our overall financing requirements. Our term loan at 40% is 16% of our overall financing, etc., etc. Down below here, you'll see we have the same items, only capital structure does not include our short-term items. It just includes those long-term costs. So that includes our share capital, retained earnings, and long-term borrowings. And again, 100 plus 58 plus 50 gives us 208. $100,000 divided by 2.8 gives us 48%. 58,000 divided by 2.8 gives us 28%. And so this gives us an easy way to break down where our financing is coming from, both short-term and long-term. Now this actually leads into self-test 9.2. So we have to do this first. We have to get this proportional weighting to see where our financing is coming from. And then as we look down below, what we're going to do is calculate what's called a weighted average cost of capital, or WACC, W-A-C-C. So again, the weighted average cost of capital is simply an extension of our capital cost. And so if we take the information from above and bring it down below, what we have here is the same table from above, only now we're adding to it. So here we have our interest rates. These are the costs. So the share capital means our shareholders, our investors, are demanding a 12% return. Our retained earnings, we ourselves are also demanding a fairly high return because we can invest our money anywhere. So if we're going to invest it in the business and future projects, that project better pay for itself. So we're going to take our money and we're demanding an 11% return. Our long-term borrowings, our bankers essentially are demanding a 5% return. This one loan is demanding a 7% return, and any working capital, i.e. in this case a line of credit, is demanding a 6% return. Well, continuing on from the information above, right? So again, this is the same table from above, but all we've done now is we've added in the costs of each particular source of financing. So if we want to see what the weighted average cost of financing is, we take our proportional weight, and again, this is what we calculated above, and we're going to take our proportional weight and we're going to multiply it by the cost that each outside group or internal group is demanding from this project, right, or from us. So here, 40% of our financing is demanding a 12% return. That means the weighted return for those individuals is 4.8%. Again, at 58% divided by 248 is 23%, and 23% of those that financing demands an 11% return. That means at a weighted proportion, it's 2.6. All right, and so forth and so forth and so forth. Now you'll see down here 9.5. I'll just calculate that again. So I'm just going to delete that number. If I calculate that, I'm simply adding up all my proportional costs. So I just go sum. I'll just sum this total thing up, again at 9.5%. And again, the cost of financing includes all our sources of financing. However, on those times when we want to invest in larger projects, whether it be, say, a new plant or agricultural, maybe it's a new field, new pieces of equipment, maybe we're investing in drones rather than a traditional sprayer, something along those lines. Well, if that's the case, we need to figure out how we're going to pay for it, and then we need to figure out what kind of return we are going to demand from that particular project. because again, all our external shareholders, or external lenders rather, as well as our external shareholders and our internal departments, they will demand a return from each project. So the weighted average cost of capital, again, this is long-term items, not short-term. So we have share capitals, we have people buying shares to invest in this, we have our long-term earnings that we're investing into this, as well as long-term loans that we're investing into this. So here the cost here is $208,000 that we are raising, and that's 100 divided by 208 is 48%, and 48% again wants that 12% return, 28% wants this 11% return, 24% wants a 5% return, and so my weighted average cost of financing, 48% times 12% is proportionally 5.8%, 28% times 11% is 3.1%, 24% times 5% is 1.2%, and if I add those up, that gives me a return of, nope, that's not correct. Do that again. There we go. That means this project needs to earn a return of 10%, and that 10% will simply allow me to, or a project, to pay for itself. All right, down below I have economic value added. To be honest with you, I bring this up quickly in class. I never really do a lot with this one. And so I've got the information here, and on Moodle, you'll notice I've included a short video that I've shown in previous years that demonstrate how what EVA is, economic value added, and how it's used in industry. And essentially what we're using EVA for is an assessment tool. So we want to ensure that our managers or our department heads are actually adding value to our organization. And so what we want to do is make sure that they're making good financial decisions, right? They're using our assets in a good way. They're taking out good loans, that kind of stuff. And so the economic value added will give us a formula that we can utilize to ensure that our managers are making not just good decisions, but good financial decisions, that they're actually earning money for us. All right, so both the video and the textbook does a good job outlining that. And generally in class, all I do is show the video and then move on. All right, so you'll see just a quick note here down to watch the video. So I've only got a couple minutes left in my 15 minutes, so I'll scroll up here. And 9.4, 9.5 is actually more or less just a continuation of the cost of capital and the economic value added theory. So self-test 9.1, self-test 9.2 bring forward the concepts of the weighted average cost of capital. And then later in this chapter, what we see are sources of long-term debt. We see the costs, we see different ways of raising it, and that's what table 9.1 and 9.4 and 9.5 look at. And I realized the table here, I had to shrink it in order to get it into the spreadsheet. It's pretty small, hard to read. So you can take a look at table 9.4 in your textbook as well. All right, so going down, again, weighted average cost of capital. The only real thing that I'm introducing here is that there are costs, there are tax costs associated with this. And so looking at this, all right, again, I think self-test 9.4, we've already gone through this. It's basically the similar to 9.4 or 9.2 rather. But if I look at self-test 9.5, we have some good information here, and if I scroll down, we've got our table. Now, the only thing I really want to introduce here is that there are tax benefits with taking out certain items. So common shares, those are all done after tax. Retained earnings, they're done after tax. So there's no tax savings when we issue common shares, and no tax savings when we use our retained earnings. However, if we take out debt, we have to pay interest on that debt. Interest costs are tax deductible. So that actually gives us a tax savings. All right, so again, whenever we look at traditional debt, loans, we have tax savings because of the interest. And so the after-tax cost is actually the interest rate, right, of 10% and 13% from our textbook. And then all we do is we take 10%, multiply it by 1 minus the tax rate, because those are the tax savings. So 10% times, in this case, 1 minus 0.33, or 10% times 0.77, gives us 6.7% interest. 13% times 1 minus 0.33, or 13% times 0.77, again gives us an after-tax cost of 8.7%. All right, so when we're looking at mortgages, when we're looking at debt, interest, anything we're paying in interest, we don't just look at the pure cost, we have to look at the after-tax cost. All right, so that's about my 15 minutes right there. I do realize I've run through the theory here quite quickly, so I hope this is enough to get you started. Work through the tables. I mean, I've already put all the solutions in there for 9.1, 9.2, 9.4, 9.5, but work through the tables, take a look at the theory, and then what I'll do is, again, go through this, not quickly, but from a high level when we get back in class here next week to address any questions that you guys have. And lastly, I will state that leverage is not part of this course, so I don't cover leverage, nor do I test on it in any way, shape, or form. So the latter part of Chapter 9, anything that deals with leverage analysis, you are most welcome to review the material, but I will not be testing you on the material in any way, shape, or form. All right, so for those of you that are heading to Canmore for AgX here this week, have a great time. It's a wonderful conference. I've done it in the past. And I will be in class tomorrow, by the way. I didn't state that, but I will be in class tomorrow for anybody who is not going to be at AgX. So if you have any questions, I'll happily be there. I will not be in class on Thursday. So over the next few days, if you have any immediate items, please email me. I will be at a funeral on Thursday, so I'll not be answering any emails on Thursday, but I should be able to answer emails on Friday, and I will be around on Monday as well if there's any questions in case anybody wants to get together. All right, so I'm over my 15 minutes, so have a great day, have a great week, and I'll talk to you guys soon.